Thank you for joining us. With me today are CEO Christian Klein and CFO Dominik Asam. On this call, we will discuss SAP's fourth quarter and full year results for 2024. You can find the deck supplementing this call, as well as our quarterly statement on our investor relations website. During this call, we will make forward-looking statements, which are predictions, projections, or other statements about future events. These statements are based on current expectations and assumptions that are subject to risks and uncertainties that could cause actual results and outcomes to differ materially. Additional information regarding these risks and uncertainties may be found in our filings with the SEC, including but not limited to the risk factors section of our annual report on Form 20-F for 2023. Unless otherwise stated, all numbers on this call are non-IFRS, and growth rates and percentage point changes are non-IFRS, year-on-year at constant currencies. The non-IFRS financial measures we provide should not be considered as a substitute for or superior to the measures of financial performance prepared in accordance with IFRS. Christian, now over to you.
Yeah, thank you, Alexandra, and thanks to everyone for joining our earnings call. 63 billion euros, that is SAP's total cloud backlog at the end of 2024, up 40% over the previous year, hitting a new record high. Total cloud backlog is just one figure, but it illustrates how far we have come as a company. 4 years ago, SAP shares took a hit when we announced our plan to transform the company. The markets had some serious doubts if we could pull it off, but we did it, and we delivered on all of our strategic promises. We more than doubled cloud revenue since 2020 and raised it to half of SAP's total revenue today. No major competitor is growing as fast as SAP. And with a total cloud backlog of 63 billion euros and an 83 recurring revenue share, we are on a more resilient growth path than ever. SAP has enormous potential and a bright future. Over the last several years, we have developed a very compelling business suite offering in the cloud to run our customers' most mission-critical business processes end-to-end. We also have access to business data that no other tech company has. And with regard to AI, yesterday's tech news provided another strong validation of our strategy. Thanks to our ecosystem approach on the Gen AI Hub, we are flexible when it comes to AI infrastructure and large language modules. We benefit from cost reductions and progress in the LLM space. Because we are truly differentiating an element in AI today, however, it is deep process and industry know-how combined with access to unique, context-rich business data. So, value creation is more and more moving up the application layer and to building one semantical data layer. This is exactly what SAP has been focusing on. We have been embedding SAP Business AI deeply in the business process of our customers. The result is that C-suite executives see us as the leading AI company in Europe and among the top 5 globally. Accurate business data and an understanding of its semantics, those are key ingredients to generate major value and to expand our competitive edge. I will touch on that and an exciting innovation in the data space in just a minute. The financial results for 2024 are another proof point of the successful journey we started. We had the courage to change our business model, and 4 years later, we are winning in the cloud and in AI big time. Becoming the #1 enterprise application and business AI company is a huge achievement by Team SAP. It took a lot of effort, dedication, and openness for change to get there. A big thank you to our over 100,000 colleagues worldwide. Before we take a closer look at SAP's future, let's review how we ended 2024. Q4 was a very strong finish for the year. Without going into all the details, let me mention 3 points. Cloud revenue expanded 27% and drove double-digit total revenue growth for the 3rd quarter in a row. Current cloud backlog once again increased 29% on top of an already larger base. And the most exciting thing, about half of our cloud order entry in Q4 were deals that included AI use cases. This shows how successful we are in rolling out business AI innovations to our customers. As for the full year 2024, we achieved all our cloud goals, despite macro headwinds and the ongoing transformation inside SAP. This wasn't easy, but we did it, and we are very proud of that. The customer stories that capped off the year give you a good idea of where SAP is heading. In Q4, more of the world's leading companies decided to embark on their WISE journeys. The energy companies BP and Total Energies are two great examples. BP chose WISE as the digital backbone for the transformation into an integrated energy company, helping to accelerate digitization, enhance performance, and reduce costs. Easy access to technological innovation was another important factor in BP's decision. And Total Energies has been partnering with SAP for over 30 years. WISE will be the starting point for the company's transformation towards new business modules, and it will help to drive efficiency. And from there, we will take our partnership to the next areas. BASF, the world's largest chemical company, is also banking on WISE. Together, we will drive process simplification and standardization. And we will enable BASF to take advantage of AI-powered automation and innovation. I could go on and on. So many more global leaders chose WISE in Q4, including Red Bull, EY, the European drugstore chain DM, and the automotive suppliers Robert Bosch and Schaeffler. With regard to GROW, we once again celebrated major wins in the IT industry. Databricks, a rapidly growing data and AI company with over 10,000 customers, has selected GROW to modernize its financial systems and support its growth. Databricks will now have a solution that can scale fast in over 60 countries, supports new revenue modules, and provides the company with instant access to business AI. And Outreach, a SaaS company focusing on sales solutions, signed up for GROW in Q4 as well. Let me say this very clearly. SAP adds hundreds of net new cloud SME customers every quarter, who go on to celebrate go-lives in months, not in years. End users are delighted about the product experience of the suite and the new innovations coming in every quarter. This is the new SAP. Next to these customer wins, we also saw some major go-lives. Let me name some big ones. IBM went live with SuccessFactors for its over 275,000 employees in over 80 countries. It was one of the largest and most complex deployments of SuccessFactors in the history, and delivered completely on time. And IBM also went live with SAP Fieldglass and SAP Ariba in NS2 for its federal business, as the first customer to use both solutions in the NS2 cloud. We also had major WISE go-lives in the automotive sector. Those were General Motors and the Germany-based automotive supplier Mahle International. All the examples I gave make it very clear. More and more customers appreciate the comprehensive and integrated character of SAP's cloud suite. They start with finance, BTP, and our business transformation portfolio. And from there, they expand to our full suite, to all our line of business solutions, following our WISE or GROW journeys. For our customers, it is just so easy to adopt more and more of our solutions. The number of customers with over 4 SAP solutions more than doubled since 2021. Over 1/5 of our customers are now part of that group. Land and expand is clearly working. So, we had a really great one. 2024 was another very good year for the company. But we are not stopping here. We are raising the bar for the years to come. We expect accelerated double-digit total revenue growth and an expansion of operating profits through 2027. We can say this with confidence because we have all the right pieces in place. First, product innovation. Overall, we brought over 130 Gen AI use cases to our customers in 2024, over-delivering on our plans. And we integrated 1,300 skills in Joule, making it capable of automating 80% of the most used activities of our end users. More than 30,000 customers now use SAP Business AI. Among them, many great brands such as Campari, Henkel, Mercado Libre, BT Group, and Standard Chartered Bank, and other big names. For example, ABB, Bayer, and the Swiss retailer Migros signed deals for SAP Business AI in Q4. All this is a very good start, but we are once again doubling down on AI in 2025. We will significantly increase our AI investments with all of our more than 30,000 developers working to enhance our AI foundation and building new use cases. One key ambition is to make every Joule user 30% more efficient by the end of 2025. In addition, I can't wait to launch a game-changing innovation very soon that will give us a great boost in the data and AI space. Today, companies spend up to 50% of their IT budget on data and analytics. And despite all of that investment, so many companies fall short of realizing the potential of their data. Too often, data stays locked in silos or is stuck in so-called data swarms without business context. Companies have no complete view of their business that way, and without access to high-quality data, AI agents stay far below their potential as well, according to the principle garbage in, garbage out. We will address these challenges in the data and AI space with one of the biggest innovations SAP has ever delivered. We will harmonize structured and unstructured data, SAP and non-SAP data, always with the relevant semantics. And by that, we will make AI agents much more powerful. Joule will become the super orchestrator of these agents, carrying out complete tasks autonomously and end-to-end, taking over significant workload from humans. At our Business Unleashed event on February 13, we will talk more about this innovation. It would be our pleasure if you joined the webcast. Let's now move to the second piece, commercial innovation. First, we will make it even simpler for RISE and GROW customers to land and adopt our latest innovation. We will introduce licensing options that allow customers to upgrade and switch easily to our newest cloud solutions across the whole SAP Business Suite, all without additional negotiations. Second, for customers that have landed with SAP, we will enhance strategic migration incentives to expand across our SAP Business Suite. The broader customers go, the more they benefit. Third, we will evolve our RISE with SAP offering. Our whole business transformation toolkit will be part of the RISE offering going forward, including LeanIX, Signavio, and WalkMe. In addition, we will leverage Joule for Consultant and Joule for Developer for our customers' transitions to cut migration costs. Supported by the enterprise architects, we will accelerate time to value and allow customers to benefit from our full business suite even faster. And now to the third piece, simplification. We are very diligent and committed to making SAP simpler, leaner, and more efficient. By rolling out AI internally, we enable our business to scale quickly while keeping costs in check. To give some details, in development, over 20,000 SAP developers use AI-powered tools, including Joule for Developer, already today. We are seeing average efficiency gains above 20%. On the go-to-market side, AI-assisted contract validation has reduced our average contract booking time by 75%. And in the corporate functions, we have seen a 20-fold productivity gain through AI-assisted quote-to-cash process automation. Overall, we expect a one-weight efficiency effect of our existing AI implementations of roughly 300 million euros already this year. And for the very near future, we expect to cross the $500 million mark. In parallel, our transformation towards a better, more resilient, more simple SAP continues. In 2024, we started to merge our 7 go-to-market regions into 4. We have also consolidated our operations teams, reduced shadow functions, and streamlined the delivery of solutions to customers. And we are putting the right people in place. This morning, we were happy to announce 2 chief revenue officers co-leading our go-to-market execution and transformation, reporting directly to me. Jan Gilk as Chief Revenue Officer, Americas and Global Business Suite, and Manos Raptopoulos as Chief Revenue Officer, APAC, EMEA and MEE. They will be supported by Stefan de Basre. Stefan joins us from 09, where he was Chief Revenue Officer. He will serve as Business Suite leader and ensure the success of our suite motion across regions. This combination from in-depth product knowledge to world-class sales experience will allow us to further improve our go-to-market while staying focused on our commercial success. On the R&D side, we are extending the mandate of our Chief AI Officer, Philipp Herzig, to also head our cross-company innovation efforts as new global CTO, continuing to drive AI innovation for SAP's customers and partners. Also this morning, we announced that the Supervisory Board has appointed Sebastian Steinhäuser as an executive board member, effective February 1st, 2025, in the role of Chief Operating Officer. Sebastian oversees the execution of our strategy, as well as the simplification of our internal operations. In addition, the Supervisory Board extended the Executive Board contract of Thomas Saueressig for 3 additional years until 2028. I'm very much looking forward to working with this strong and extended team. Let me now summarize. Our success over the last 4 years speak a clear language. We are capable of turning ambition into reality, and we intend to continue that way. We are curious about the future and set the bar higher, because being the best is never done. With this drive and energy, we are continuing our profitable growth journey in 2025 and beyond. That is our aspiration. This is our promise to you. And with that, I'm handing over to Dominik.
Thank you very much, Christian, and thank you all for joining us this morning. I would also like to wish everyone good health, peace, and success in 2025. SAP's strong finish to 2024 once again demonstrates great resilience in a year that presented new challenges and opportunities. We not only delivered on our financial commitments for the year, but also built strong momentum that positions us firmly on track to achieve our stated financial goals for 2025 and beyond. 2024 was a year of transformation, highlighted by both top and bottom line growth, as well as exceptional free cash flow strength. Our success in cloud revenue and robust non-IFRS operating profit throughout the year reflect the effectiveness of our strategic growth initiatives and our relentless focus on operational efficiency. Customers worldwide continue to choose RISE with SAP as their solution of choice for the end-to-end business transformations in large-scale enterprises, while small and medium-sized companies rely on GROW with SAP to drive their growth and innovation. This is reflected in strong order intake and large cloud transactions, with a volume greater than 5 million euro, contributing 63% to our cloud order entry for the full year and an impressive 68% in Q4. Now let me provide more details around our financial highlights. Current cloud backlog reached 18.1 billion euro, up 29%. Total cloud backlog for the year grew at 40% to 63.3 billion euro. Cloud revenue grew 26% year-on-year, supported by cloud revenue growth of 27% in Q4, primarily driven again by the strong performance of Cloud ERP Suite. It actually had an impressive year, demonstrating its role as SAP's core driver of growth, with an increase of 34% in 2024, up from 33% in the prior year. Cloud ERP Suite reached 84% of total cloud revenue in Q4, underscoring its growing contribution to our success. Software licenses revenue decreased by 21%. Finally, total revenue for the full year exceeded 34 billion euro, up 10%. This performance was mainly driven by strong growth in cloud revenue and resilience of our support business, reflecting the ongoing progress of our strategic pivot towards cloud-based solutions. Now let's take a brief look at our regional performance for the full year. Germany, Spain, China, India, and Japan all had outstanding performances in cloud revenue, while Brazil, Canada, and Saudi Arabia were particularly strong. Moving down the income statement, our non-IFRS cloud gross margin for the full year continued its upward trend from last year and expanded by 1.4 percentage points to 73.3%, driving cloud gross profit up by 28%. In the fourth quarter, non-IFRS operating profit was up 24%. Operating profit growth in Q4 was mainly driven by the strong performance in SAP's software licenses and support business, as well as disciplined execution of the 2024 transformation program. For the fiscal year, we delivered outstanding operating profit growth of 26% year-over-year, reaching 8.2 billion euro. The IFRS effective tax rate for the full year was 34%, and the non-IFRS tax rate was 32%, in line with what has been previously guided. Free cash flow for the full year was down 19% to 4.1 billion euro, exceeding the revised outlook range of 3.5 to 4 billion euro, which was provided in the prior quarter. Recall that on top of payouts for restructuring of 2.5 billion euro, we also absorbed 0.2 billion of cash out for compliance-related settlement matters and fully discontinued SAP-triggered financing, weighing with another couple of 100 million euros on free cash flow. On the other hand, we received a couple of 100 million euros from customers for receivables due in 2025 before the turn of the year, which in combination with strong profitability enabled us to slightly exceed even the upper end of the previously guided range of 3.5 to 4 billion euro. Non-IFRS basic earnings per share in fiscal year 24 increased by 22% to 4.53 euro. Now, let's move on to our outlook. As you've likely seen in the quarterly statement published earlier today, we have provided this year's outlook. 4 years ago, SAP outlined bold long-term goals to guide our transition towards cloud-based solutions. Today, we are proud that this year's outlook solidly aligns with the ambitions we set in 2020, demonstrating the progress we've made in executing our strategy. Before I move on, I want to provide an update on our compensation metrics and foreign exchange hedging strategy that we will adopt going forward. As of 2025, we will enhance our compensation framework by incorporating free cash flow as a metric alongside non-IFRS operating profit. This will ensure heightened attention towards working capital and other drivers of free cash flow. Additionally, to reduce foreign exchange-related impacts on free cash flow, we have further developed our hedging strategy, in particular for the US dollar. As a reminder, we currently provide all income statement KPIs that are relevant for compensation purposes on a constant currency basis. Free cash flow, however, has been and will continue to be provided on a nominal currency basis, as unlike the compensation-relevant income statement KPIs, it does include the result from foreign exchange hedging. We continue implementing a hedging strategy with a lead time of up to a year to mitigate the risk from US dollar-euro exchange rate fluctuations. By aligning hedging instruments with forecasted cash flows and maintaining a 1-to-1 hedge ratio where possible, we aim to reduce volatility and minimize the impact of exchange rate fluctuations on our free cash flow. This approach is largely completed by now and reflected in the free cash flow outlook we have provided today. So while the average exchange rate for 2024 and as a result constant currency exchange rate for 2025 underlying our outlook for income statement KPIs is 108, the spot rate today and at year end 2024 relevant for CCB was 104. The forward rate of our hedge portfolio for free cash flow for 2025 sits logically in between at around 106. Now let's quickly discuss our non-financial KPIs. In 2024, we continue to see strong uptake for SAP Sustainability Solutions portfolio with robust growth of approximately 70% for our sustainability innovations. Q4 was very successful, particularly in our MEE and EMEA regions, including a key win with Knapp, an Austrian logistic automation company, purchasing SAP Sustainable Control Tower, SAP Sustainable Footprint Management, and SAP Sustainability Data Exchange for sustainability disclosure and carbon accounting, including supply chain engagement. Companies like Knapp are turning to SAP to be the foundation of their sustainability reporting. Regulations, customer need for supply chain transparency, and the ongoing convergence of sustainability and financial standards continue to drive and play to our strength globally, demonstrating sustainability as a core business and ERP requirement. Now, in Q4, we released the highly anticipated SAP Green Ledger. Together with our sustainability portfolio capabilities, which provide data collection, calculation, and auditability, the SAP Green Ledger allows customers to sync emissions data with financial data for strategic and contextualized business decisions that are both financially and environmentally sound. This also helps companies fulfill regulatory requirements. Now, in summary, we delivered on our key objectives for 2024, achieving strong top and bottom line results while demonstrating resilience in a dynamic environment. Customers continue to choose our solutions to help transform their businesses into more intelligent, sustainable enterprises, as reflected in our cloud performance across all regions of the world. With our foundation now firmly established in 2025, we must remain vigilant in our execution to sustain growth and set the stage for long-term success for years to come. This progress would not have been possible without the dedication and hard work of our people, both those who remain with us and those who have moved on. We deeply appreciate their contributions to helping SAP navigate their transformational journey in this year. We remain optimistic about the opportunities ahead, confident that our commitment to innovation and disciplined operating strategy will continue to drive positive results. Thank you, and we will now be happy to take your questions.
Thank you, Dominik. And with that, we will now take your questions. I would like to kindly remind you to only ask one question when prompted. Operator, please open the line.
Ladies and gentlemen, at this time, we will begin the question and answer session. Anyone who wishes to ask a question may press star followed by 1 on their touch-tone telephone. If you are using speaker equipment today, please lift the handset before making your selections. Again, anyone who has a question may press star followed by 1 at this time. One moment for the first question, please. The first question is from the line of Adam Wood with Morgan Stanley. Please go ahead.
Hi, good morning, and congratulations on the excellent end to the year. Maybe if I could ask just a little bit around CCB and the kind of stage of the upgrade cycle to S4 in the base. just in that context, we've obviously got very strong CCB growth at the end of 24 with that acceleration, TCB accelerating, but you're talking about a little bit of a slight deceleration on CCB for 25. Can you just help us understand how much of that is just the fact that you can't keep accelerating that number off ever bigger numbers? And in that context, give us a little bit of a feel for where you think the install base is in terms of the upgrade to S4. How much of there is there still to do? Basically, are we hitting the peak of that upgrade, in the near future, or do you think there's actually a lot more to go for as we look out over the next few years? Thank you.
Good morning, Adam, and I can start and look at CCB. Indeed, we had a record Q4 exceeding all our expectations. Now for next year, to give you a few installed base, we are roughly 40% of our customers are on their move with RISE to our business suite in the cloud. 40%, that doesn't mean even that all of their landscapes are already in the cloud. So that contracts include a significant ramp towards the later year. So that gives us, even the 40% who are on their way will also give us further acceleration in the years to come. And then also when you look at Quo, I mean, we are actually adding hundreds of net new names, as I mentioned, and also our win rates in the public cloud. Yeah, when you look at the different LOBs and the win rates against the best of breed is going up, because clearly now the customer's seeing, hey, it's really about land, expand, and running my core business processes integrated end to end, and of course then with AI out of the box. So yes, the base is getting bigger indeed, but when you look at the absolute growth, it's also further accelerating. I mean, we are putting a ton of new business on top, and also let's not forget, Adam, at a certain point, it's also now important to drive adoption. Our retention rates are getting better and better. And so I feel the outlook is actually really ambitious. Also, given, honestly, the macro environment, and you see in the cloud revenue, there is no slowdown. This is actually an acceleration. And so the two things coming together, higher retention, higher adoption, further acceleration of the customers who are already on the move to the cloud, higher win rates in the different line of businesses. So, Adam, absolutely, we are very confident for the year ahead, and honestly, also for the year beyond. The install base, look at the maintenance revenue number, still gives us a lot of potential to move customers to the cloud. And then again, also not only upselling these customers, but also cross-selling, as I mentioned.
May I add one point there? If you look in the sell-side estimates, we see that there is still a little bit of a kind of doubt in terms of our revenue acceleration thesis through 27. And what I encourage you to do is to kind of back solve how much CCP can actually decelerate before you would kind of not see that acceleration in consolidated revenue. So the mix factor, I'd say at the sweet spot of the revenue mix play, giving us a boost on total revenues. And so this kind of slight deceleration we have guided here is actually probably much better than what is embarked in some of the models we see on the sell side these days.
Yeah, and maybe one piece to add. I mentioned two large energy companies, but we also signed up for many automotives. So also given they are not in a good position right now, given all the concerns which are existing in this industry. But still, they're shifting. Maybe now the first part or maybe 1/3 of the landscape to the cloud, but then really focusing, and that is the value add. They are not only lifting and shifting to a cloud infrastructure. We are intensively working now on process simplification. They need to run new business modules. And then give them a year or two, and then they will actually sign another contract. So, Adam, it's also a phasing. And we want to be reasonable in our outlook, how we also reflect this phasing of these RISE deals, because customers need time. I mean, changing business modules, it's not only a technological move, it's about change management. It's sometimes, I have seen this 4 years ago, also, breaking the walls, there is some change resistance, but cloud software needs simplification. We move to a new technological architecture with BTP. So let's also give the customers some time, but there is enough potential also in the install base left.
The next question is from the line of Jackson Ader with KeyBanc Capital Markets. Please go ahead.
Great. Thanks for taking our questions, guys. Our questions around migrations in 2025. So if we expect some of the CCB to slow down a little bit and cloud revenue growth to accelerate, overall revenue growth to accelerate. I'm curious, what should be the expectation for support revenue in 2025 as you continue to drive more of those migrations in the coming year, and how that flows into cloud revenue as well? Thank you.
Yeah, it's a very good question, and it gives me an opportunity also to comment on what looks to be a slightly odd Q4 with actually an increase in maintenance. This is certainly not a trend. It is simply related to the fact that actually we caught up on some revenues we carved out previously because to a financial distress of a larger customer that had a financial restructuring, and then we could re-embark these revenues, while in the Q4 of the prior year, there were actually some compliance-related carves on maintenance revenues, and that made the whole thing flip. If you depollute it for that, you see it's a very steady, slight decline. And as previously guided, no change to that. We will kind of see a gradual decline. Obviously, the slightly higher than anticipated license revenues indicate that also maintenance revenues have a little bit of a longer life. Yeah. But overall, we would not deviate from that hypothesis of a slight acceleration over the coming years in maintenance revenues, but don't expect a complete collapse. And again, the good news is we have that gradual rollover from that maintenance base into cloud revenues.
And maybe just to build on that, sometimes in the world, when geopolitical tensions increase, customers already, see again even more value coming also back to SAP for SAP support. I mean, given legal and regulation support in over 130 countries is a real asset. I mean, the same is also what we see now in the cloud. If customers want to expand their business, they need localization, so it's a real asset. So that while you also see this very high retention rates on support revenue. And also with the move now that we allow our customers to move to the cloud, and while they have 100 ERPs from SAP and they need time to consolidate, we offer them now to replace some third-party assets in the stack and to really allow them, to continue their transformation while not getting hit by the end of maintenance, which will stay in place, of course. That, of course, is even a reason more to come back to SAP and allow, and see really the great, value of SAP support.
The next question is from the line of Johannes Schaller with Deutsche Bank. Please go ahead.
Yeah, thanks. Good morning. Thanks for taking my question. Christian, I think you probably just touched on this topic in your last remark, but there's obviously been a bit of press coverage around potentially extended maintenance. I think some people suggesting 2033 is the new 2030, which is clearly not the case. But can you maybe help us a little bit more with some detail understanding what's the reasoning behind this SAP ERP Private Edition option? And what is generally going on in the installed base? I mean, is this really what some of your larger legacy customers needed to get them kind of over the line and then sign some of these deals? Or is it really that you maybe not seeing the kind of momentum with some customers that you were hoping? Thank you.
Yeah, happy to answer that question, Johannes. And look, I mean, as I mentioned, some of our customers have over 100 ERPs. I mean, they're running factories, manufacturing, and logistics with that. And now the end of maintenance by 2027 will not be changed. We will stick to that. But you also have to consider in some parts of the stack, there are third-party components included, and they are running out of maintenance as well. So, we don't want to leave the customers behind. And, as we moved all of our cloud solutions already on HANA Cloud, we do now the same with these on-premise customers. We move them to the cloud, we replace the third-party components, and with that, we can also, run in the cloud, there are 100 ERPs, in a complete sustainable and supported way. And that is about this offering. It's actually for a very few large customers who will not make it in time because, again, to transform and consolidate ERP and business processes in over 100 countries is sometimes not that easy. And that is what this offering is about. So it's not about the extension of on-premise maintenance. And clearly we see the acceleration in the cloud, but it's really, reaching out with a helping hand to a very few large customers who need this offering, to fully transform and migrate to the cloud. This is what this offering is about.
The next question is from the line of Mohammed Moawalla with Goldman Sachs. Please go ahead.
Great. Thank you. Morning, Dominik. Morning, Christian. Dominik, I wonder if you could just clarify the thought process around some of the moving parts on the FY25 outlook. You obviously raised your EBIT guidance, but I know there was a definition change on the free cash flow. I know the tax rate's also gone up a little bit, and there's more restructuring. Has anything else changed just to kind of bridge the gap in terms of assumptions around working capital? And what are the plans in terms of the impact you expect on that over the next couple of years? Thank you.
Yeah, I mean, working capital is always extremely hard to predict around the turn of the year. You might receive some payments you didn't expect, or take the massive performance we had in Q4 on new bookings. You recall that we're also offering transformation credits to customers to incentivize them and help them with the transformation period, which is actually creating some upfront cash out relatively to the phasing of the profits in these customers. And all that taken together has resulted in the outlook we have given. You've seen that we have kind of pulled in some cash in 2024. So we were ahead of plan in 2024. And that obviously, like money you receive early, you won't receive any more in 25. On the other hand, we also operationally make good progress. I think it's interesting to look into our cash flow statement. It's page 14 of the quarterly statement, and you see some promising signs. For instance, trade receivables increased under proportionately, so the cash out is lower than in the prior year, despite the fact that we had the normalization of these vendor financing things. So that should actually increase accounts receivable. You see that we are quite disciplined. And another extremely important topic for cash conversion is actually stock-based compensation. And it was a little bit strange in 2024 because we had this huge increase in the share price, and we still had quite some cash-settled units, which are partially also paid out in 2025 still. And what I can tell you on that front is, again, you look at the cash flow statement and you see share-based compensation in the P&L was 2.4 billion, which frankly is higher than what we thought because of the strong share price increase. You recall that for 2020, we actually said it should be more about 2 billion. Sorry, for 2025, it should be more about 2 billion when we adjusted for inclusion of stock-based compensation. When was it? A couple of quarters ago, a year ago almost. We had 2.2 billion in 23. We said it will transition to 2 billion. Now it's 2.4 because of the huge increase in share price. But we continue to believe that the P&L impact of stock-based compensation will go down once we have this effect reduced from share price moves. And then the cash out is much smaller, of course. So you see 1.3 billion in the statement. Both in 2023 and 2024, there was a 1.1 billion positive from conversion of stock-based comp, which is simply the equity settled part. And that is a number I can tell you will be quite similar next year. So as you strongly reduce stock-based compensation, that reduction will then, if the delta is the same, hit very much the cash flow. So all these things need to be taken into account, are embarked here. And I agree, it's not straightforward, but I encourage you to look at cash conversion and look at basically the depolluted free cash flow. If we add that restructuring, we add back the compliance charges, we add back the factoring. These are the three factors I would always kind of depollute to come with an underlying cash conversion number. And then on stock-based compensation, I gave you the hints how this will evolve, and we can also go in more details offline about that. And that number is a very high number, honestly. If you think about EBIT tax affected, you will see that we are actually currently running better. And that is also because of the catch-up we have on some of the working capital items. And we will need to continue to grind on that to really keep that extremely good cash conversion we had in both 24 and is actually also applied for 25.
The next question comes from the line of Sven Merkt with Barclays. Please go ahead.
Great. Good morning. Thank you for taking the questions and congratulations on the strong quarter. If you look back to 2024, cloud growth, you added about 3.5 billion euros. Can you give us just a rough indication how this breaks down into maintenance, conversion, up and cross-selling, as well as net new sales, and maybe how you see this evolve into 2025? Thank you.
Yeah, let me share a bit more insights about, how, of course, we close cloud order entry and then how this translates into CCB. And when you look at Q4, of course, by far our biggest quarter, and I have to say really a record quarter, 60% roughly from the cloud order entry comes from, iBase customers moving to the cloud. Then you get, another 30%, from net new and roughly 10% about, upselling, into the existing installed base. So you see the mix in my eyes is actually really healthy. And for me, next to the strong move of the installed base, which still, as I mentioned before, has a lot of potential for the years to come. For me, even more important is, of course, the net new, because that is, what is really then, adding completely, incremental business on top, which then also gives us, the great, a performance on total revenue. Now, on maintenance conversions, I mean, we always have these multiples that developed in Q4 also extremely well. Actually, we have a multiple of slightly around about 3x, which is very strong. Given also, and you can see that in our cloud cross margins, I mean, we clearly did our homework there. I mean, both for the private cloud and the public cloud business, the expansion of the cross margins is very strong. And I have to say, looking at our plans for the year to ahead and everything, what you saw yesterday, the cost reduction on large language modules and other things we are trying to get down the TCO in our cloud operations gives us actually also the potential to further reduce TCO and with that also expand, our very healthy cloud cross margin in the years to come.
The next question comes from the line of Toby Ogg with JP Morgan. Please go ahead.
Yeah, hi, morning, and thanks for the question. Perhaps just on AI, could you give us an update just on how Joule is tracking in terms of adoption, whether you're actually seeing any revenue generation yet from the monetization of Joule, and then just how we should think about the timeline for potential contribution to revenue growth from the monetization of Joule and agents? Thank you.
Yeah, I can actually share with you a story from yesterday where we had a CFO of a big, large German company here with us in our headquarters. And we looked at agentic AI with Joule as the so-called orchestrator. And we shared, what is coming in 2025. And we shared an example to improve cash collection. And what we did is actually we looked into some delayed payments in the life system of the customer. We actually showed him what are the reasons. Joule actually showed what are the reasons for the delay. Is it logistics? Is it a supplier? Is it actually some issues, in the delivery, or is it a commercial issue? And then you saw how Joule was reaching out to the different agents on the logistical side, on the procurement side, supply chain, or on the sales side, and was really able to pull in a dispute and really helping to resolve the case fully automated. Still, of course, a human being sitting at top, saying, yes, I want to have to create this dispute in that way. We should reach out to the customer in that way. We showed the Copilot integration. They're very deep. So you can put it in a mail, the mail gets pre-scripted, and then, actually, the human being sits there and you can look at it, how Joule is orchestrating the whole process. And of course, with different options and the right outcomes, meaning an improved cash flow. And this is, when I look at that, I can only say what we did with Philip and the team to really not focus so much on the large language models. Yeah, we are partnering, we are super agnostic, and given yesterday, I mean, this is super good news for us, but really focusing our R&D, our innovation on building the strongest AI foundation for businesses, meaning understanding of business data, contextualized business data. I mean, this is, when I have seen this yesterday, for me, is absolutely the right strategy. Now, talking numbers, I mean, you have seen 50% of the deals in Q4 were driven by AI. And trust me on one thing, given also my other role in sales, I mean, it was not only one factor. It was, in my eyes, the factor that our value engineers could go in and show the automation, the productivity, in various functions of the company, also showing what you can do with Joule as the new UX. And so that was really, for us, a key driver of our Q4 order entry. And yes, given that we actually always started with a consumption-based commercial module, I mean, of course, adoption is key from day one on, also a good decision. And now we are seeing how this, significant order entry, also driven by Joule and Business AI, is also turning into revenue. We see oftentimes, give us a 3 months delay between signing and then the go live of the first AI use cases, and then the revenue is triggering. And again, it's already a very healthy and a fast growing business.
The next question comes from the line of Frederic Boulan with Bank of America. Please go ahead.
Hey, good morning. Can we spend a moment on the cost side? Maybe if you can share a bit your, how your kind of go-to-market strategy is evolving. And when you look at the main cost levers beyond 2025, I think your guidance for this year implies still very disciplined cost growth versus revenue growth, so definitely less than the 80 to 90% you were alluded to before. So can you share a little bit the kind of moving parts beyond 25 in terms of go-to-market and overall efficiency of the business? Thank you.
Yeah, I mean, coming out of the kickoffs beginning of this year, I have to say the transformation of our go-to-market function is in full swing. Just to illustrate on what we are working on. First, the ecosystem is also now even more excited about the growth potential with SAP, as we are assigning them now partner-led territories, so they get dedicated territories to grow their business, to invest into SAP. They also very much like the fact that they can sell with SAP a suite. I mean, also the same like we do, land and expand. And so they see a big growth potential and, of course, further investing into SAP. And for us, that gives us scale, pure efficiency. I mean, we actually have enormous growth plans for the channel in 2025, given all the changes we are doing. And then on the direct sales side, I mean, we want to be much more disciplined around the number of roles we are having, around, the commissions we pay. And so we are rolling this out. The change management is in full swing. It will also give us even, honestly, some efficiencies beyond 2025. So that is in full swing. And maybe, Dominik, you can comment on the overall cost side.
I think the good news is we are de-risking the cost base, and AI plays also a big role, as Christian has explained. Yes, from the guidance you've gotten from us, you can see that we are doing better in the bridge from 2024 to 2025 than the 80 to 90% benchmarking logic we have applied. I think for the years beyond 25, 26, 27, it is still a good measurement to say in that ballpark we should end up. And this gives us then, by virtue of the acceleration in the top line, we've also indicated a good expansion opportunity for further improving the free cash flow, and then also the combination of cash flow margin growth and then the revenue growth boosts, of course, what we call the kind of rule of 40 performance of the company.
The next question is from the line of Mark Moerdler with Bernstein. Please go ahead.
Thank you very much, and congratulations on the quarter. Dominik, you've been hyper-focused on driving efficiency and improving margins while driving growth in the business. With the internal implementations of AI, can you discuss exactly how you see that translating? Is it purely going to drive margins? You talked about for what could be $500 million of improvement. Do you see that dropping to the bottom line? Do you see that as investing? Do you also see the efficiency you're doing within sales and other parts of it being able to accelerate the revenue growth and revenue growth per salesperson? Thank you.
Yeah, of course, these KPIs need to improve going forward. Otherwise, the ratio of selling expenses to revenues can't improve. I mean, obviously, as we grow the base, the incremental bookings we need are growing. So it's a mathematical necessity that the answer to your question is yes. I would say we're firmly on plan. Our confidence level on these initiatives is significant. I'd say the organizational changes that Christian has highlighted to consolidate all the operations functions in one cluster under Sebastian Steinhäuser was exactly the right move to do to really come to end-to-end process optimization. And that gives us the confidence because we have the visibility now where the building blocks are, where the kind of also impediments lie, we need to eliminate. But again, I think from a financial modeling point of view, we still want to preserve the capability to also invest in our growth and keep both the growth investment and the efficiency in sync. And that 80 to 90% leverage, I'd say operating leverage in a certain way for 26, 27 is still a good yardstick.
Yeah, and I have to say, of course, Dominik is laser focused on efficiency, cash flow conversion, but also the CEO is, of course, focused to, make SAP more efficient. But I have to say, so kudos to Dominik, Gina, Muhammad, and all the others. I mean, when you look back 1 year ago and we did our headcount planning for the year, I mean, all of us now committed because of AI on a completely underproportional headcount growth. I mean, a year ago, the headcount ask in the commercial deal support, was up to the roof, because we are closing a lot of new business. Now we have an AI capability, so Ask Joule, and a lot of the contract checkings, the RefReg checks, the compliance check is being taken over by AI. And you see this in cloud delivery, you see this in R&D with Joule for developer, and also the board colleagues, it's not only like pulling out an AI use case and see here are the efficiencies. It's about change management. It's also about, explaining to people what these technologies can do because it's changing also jobs. But I have to say, looking also at the plan for this year now, I mean, we are growing so much under proportional in many functions of the company also because of AI.
The next question is from the line of Michael Briest with UBS. Please go ahead.
Yeah, good morning. Just a clarification on the comment around maintenance. Are you not then making this extended maintenance to 2033 open to all customers? It's just a handful of sort of specially selected ones. And I'm just curious on licenses, another good quarter, but what is the thinking about potentially taking that option off of the price list and, maybe for public sector and a few sectors, it's still relevant, but for the general customer base. And Dominik, can you quickly just clarify what you mean by deceleration? Is this 100 basis points, 200 basis points for CCB? Thank you.
I can take the maintenance question. And look, I mean, first, we are legally, of course, we will opening up this offering to all of our customers. But who does really need it is really a few large customers who really ask, hey, Christian and team, we have all of these ERPs. They are already on the move, by the way. I mean, many of them, they're just saying, hey, I can do, North America this year. I can do EMEA next year, but give us, some time also for APJ before, maintenance is running out. And then say, okay, let's move to the cloud. We replace the third-party components in your stack so that you can still run a compliant business and that we can support the end-to-end stack. This is, what this offering is about. And of course, it's available to all customers. But while the move is working so well, I mean, very few large customers, which I expect will make use of this offering, which is great because we are signaling to them, hey, we're going to take you with us on this journey. We are not leaving someone behind. And you are focused on your transformation, doing the right things for your business, while we are making sure that you can still running a compliant and supported landscape also going forward in the cloud.
Yeah, on a slight deceleration on CCB, I don't want to give you precise numbers, but what I can say is what I hinted to before. There is this statement we make, this kind of ambition we expressed that through 2027, we want to see total revenues accelerate. Now, you know how the game from CCB into cloud revenues works, and you can make some educated assumptions about maintenance and license revenues going forward, and services kind of at low growth rates. You've seen a very low growth rate this year. And then you can back solve how much deceleration can we actually afford to come to kind of a steady growth rate of around about what we guided. I think it's about 11% in the midpoint we guided for 25. And of course, the deceleration lies somewhere in between, because on the one hand, it will be slower than what we have today. And also, don't forget, there is still a little bit of a positive impact from the first time inclusion of WalkMe in that 29 number. So that's a more technical aspect of that. So that one you can intellectually take out, because as soon as we have the kind of comparables of the prior year, including WalkMe, it's gone. And then there is a slight deceleration, which is kind of in between that kind of deceleration you would need to see to not see revenues on group revenues accelerate by more than 11%, and where we sit as of the end of the year. So that ballpark gives you a little bit of a feeling where that might end up.
Thank you very much, Dominik. And this concludes our call for today. Thank you all for joining us.
Thanks. Thanks to you.
Ladies and gentlemen, the conference is now concluded and you may disconnect your telephone. Thank you for joining and have a pleasant day. Goodbye.
And a very warm welcome. Thank you for joining us here live in Walldorf, and thank you to everyone who is joining us virtually. I'm Monika Scheiler, Chief Communications Officer. All numbers you're going to see today are non-IFRS, and growth rates and percentage points changes are non-IFRS at constant currencies. Our CEO, Christian Klein, will kick it off, followed by our CFO, Dominik Asam. Later on, you have the opportunity to ask questions. Should you ask questions virtually, please also give your name and outlet. And with that, let's not waste any time. Over to you, Christian.
Yeah, thank you, Monika. Welcome, everyone, here on site at our headquarters, and of course also welcome to everyone joining us worldwide. In a moment, we will deep dive on our numbers. We will talk more about our earnings today. But just attending my 5th WEF, World Economic Forum in Davos, obviously also please allow me to share a bit of the dominant topics in Davos, on the C-suite, but of course also with our political leaders. AI and Europe's competitiveness were of course a big topic. And when we look at the economic situation, I mean, for sure, the US and China have large tech players. We in Europe have one, and these tech players in the US and China are very dominating when it comes to AI infrastructure, when it comes to large language modules. And yes, for sure, we see it. AI is a very transformative technology. And it's very key that we apply AI so that our industries remain competitive. And with everything what is happening around us, I have to say, the wake-up call for Europe is loud and clear. Now, there was also a lot of talk, how should the response look like from Europe and Germany? And my strong advice also to our political leaders is not to copy the US-Chinese playbook. We in Europe have very strong industries, and we don't need the European Union or the German government to subsidize new hardware factories or products which are not competitive. This is on us, the private sector, to make the investments, to deliver great products and innovations. But what is also very key for us on the private sector is that the union, the European Union, finally becomes a union. We don't have the framework to invest and drive innovation. I mean, just to give you a few examples on the digitization, which is so key for all of the industries, not only SAP. I mean, we have one AI and Data Act for Europe, but we have 27 in each member state. So with adding one more, you are adding bureaucracy, you're adding regulation, and you kill innovation before it's actually, going into adoption. When we are talking in the United States about a sovereign cloud, we talk about one. And in this one sovereign cloud is also SAP software included, software which is also developed in Europe. So we should come together and find a very pragmatic definition about how this one European sovereign cloud should look like and how to run our workloads. And that it doesn't matter maybe so much where every piece of hardware is coming from. Security questions, fair. Where the data resides, very fair. But we need one sovereign cloud, not 27. I mean, think about it. We are a multinational. We make choices of investments in our labs in the US, in China, in India, everywhere. But for our startups, it's again a big obstacle to scale. And most importantly, what we need across Europe are bold and fast decisions. Now, asking what SAP can contribute. Sometimes it's a bit forgotten. We have a large tech company in Europe, and that is SAP. And what is the advantage of SAP? And looking at yesterday's news about the scale of AI infrastructure and the costs coming down and performance going up, I would say SAP has the big competitive advantage that we have business data no other tech company has. We are sitting at the nexus between business and technology. The value equation, how a Mercedes, how our German industry giants improve their cash flow, improve the resiliency of the supply chain, is not happening on the infrastructure layer. It's about infusing AI in their supply chain, in their finance, in their HR software. And this is, what this is about. And just to give you a flavor, we made the math. We would be willing also to invest over 40 billion in R&D and cloud operations in Europe only, SAP, 40 billion. But what we need, as everyone else, is the union we just talked about. And it's really imperative now that we take actions, both in the public and in the private sector. Talking about SAP. So, we are climbing this mountain. I hope you can see it. It was sometimes a very steep mountain. In the first 2 years, there were a lot of doubts, can SAP pull it off? And I have to say, I come later to that, I'm very proud about the team, customers and partners on how we mastered that. And when you look at our outlook for 2025, I would say it's a very confident and bold outlook. And because even beyond 2025, we actually see a continuing cloud acceleration, and we also see that our customers like the speed of innovation. Who wants to sit on an 8-year-old on-premise release with outdated components and is completely decoupled from the innovations we are shipping in our business suite each and every quarter? Agentic AI, I just talked about it, what SAP can do. And I would say the AI strategy of SAP was spot on to focus on business data, to focus on things like knowledge graph, to do a lot of R&D invest on places where SAP has a unique competitive edge. Just yesterday, and there is a demo actually out there, you can see it, we showed a German CFO how to collect cash faster by multiple agents playing together with Joule sitting on top to provide various recommendations on how to collect cash faster. Is it an issue on the logistical side? There is the agent for logistics. Is it an issue on the procurement side? There is this agent for the procurement. There is also the agent for sales. And all of them talk to each other. So cash collection will not only become more automated, you actually also see more value in collecting cash faster. And that is the next age of AI. And then 2025, and I hope you have some time for us, on February 13, we worked on the next breakthrough innovation for a long, long time. And now we are ready to launch it. And 2025 will be the year of data, and I will come in a second to this big launch we are going to have in February. Now, Q4 was strong. You have seen it. Cloud revenue expanded once again by 27%. The most important figure is for me the current cloud backlog. And 29%, think about that. The base is getting larger and larger. And, when you make the math work, you see that these percentage points are not getting easier. Still, we accelerate the CCB throughout the year. And so that gives us, of course, a lot of resiliency. And this 63 billion of total cloud backlog, which we already have signed in the books, but not yet realized as revenue, of course, gives SAP the resiliency in times where the macro is, of course, not always easier. So 2024, we achieved all our cloud goals. We doubled the cloud revenue since 2020. And I would say looking at the growth, there is no SaaS company growing faster than SAP, and the recurring revenue share of 63%, of course, again, gives us the resiliency on the top line, but as well as on the bottom line. 4 years ago, we pulled this transformation off. There were some doubts, but first and foremost, I don't want to miss the opportunity here, and we have later on an employee all hands, where I really have to say, I have to thank our 100,000 employees. And I know the speed of change at SAP was fast. People, of course, always, said, hey, there is another change. But everything what we pulled off from strategy to execution landed in these numbers. And the tech sector moves unbelievable fast. And I know we requested and asked our employees a lot, but they delivered. And so this is their success story. And of course, we have a big ecosystem of partners. We are nothing without our partners. And so also they are following their strategy. They are helping us on the execution side, be it in development, in services and sales. So kudos to also to our over 20,000 partners. And last but not least, thanks to our customers for the trust, who are always sometimes in economic tough times investing in our software as a sign of trust, seeing the value. And this is, of course, also a big thank you to all of our 400,000 customers. You see some of the plans. I mentioned in the earnings call this morning, we signed 2 large energy companies. And actually, what is so important also with these customers, their business model is changing. And so they are not only, going on this wise journey because they want to be only in the cloud. What SAP is doing is transforming their business models, helping them to run new businesses at scale, simplifying business processes. And of course, AI, as I said, is already in 50% of our deals, is a major value driver for customers signing in these days. We had major go-lives, IBM, General Motors, super, super important, of course. In the cloud, we walk with the customers every step. And customer satisfaction is key. Adoption is key. This is also what we infused into the DNA of SAP over the last 4 years. Now, numbers are up. 2024 is a great year. In the technology space, there is no time to rest. So what we have to do is we are raising the bar. We need new ideas. We need new ways to accelerate our growth and, of course, to also expand our operating profit. Not only in 2025, we are in for the mid and for the long term. So let me quickly talk about some of the levers we are pulling off. First, I talked about product innovation. This sunshine, half sunshine, it's shining because it's integrated. 4 years back, we were heavily criticized, and now we are beating a lot of best of breed because, every enterprise, no matter if you're in cloud or on-prem, and no AI will change, that needs to run integrated on one consistent data module. And that is, this is the foundation with BTP. And now we delivered already, 130 Gen AI use cases, over 1,000, narrow AI use cases, and Joule already has 1,300 skills where end users can work with, their language in translating and automating activities, what they are doing on a day-to-day basis, which is a massive boost on productivity. And in 2025, we are doubling down again. Now, I talked about this exciting announcement. Let me quickly talk about it. Today, no matter which customer, they invest a ton of money, IT money, to overcome data silos. And you can build data lakes, which is good. You can put a lot of data in a lake. That doesn't mean that your data fits to each other. That is actually the biggest challenge of all of our customers. And SAP has the commercial definition of all material, of all financial flows, of employee tasks in our solutions. And what we are doing, we are opening this up to break silos so that customers, partners, we can match semantically all data, structured, unstructured, SAP, non-SAP data, because only then you can not only run your business better and you can steer your business better, you can also exploit even more value out of AI. And especially when you talk about these agents, They won't talk to each other if you have 20 different agents from all kinds of technology players. They need to talk one language semantically. And I would really like to invite you to our Business Unleashed event on February 13. Commercials matters. I mean, we needed to make it easier for our customers to sell, to buy, to adopt and consume our portfolio. So with every RISE and GROW contract, our customers are now having the benefit to consume all of our business suite in the cloud. So they can start with finance, they can start with HR or supply chain. It's up to them. And this flexibility is key. And then they can go into their transformation journey based on their priorities. But they can land and expand without again and again having the commercial negotiations. And of course, the integration makes it easier to plug in and play. So land and expand is key for our customers, and it will get way easier, product-wise and commercial-wise. Now, simplification. Such a company, and also to be credible to our customers, obviously we need to walk the talk. So you cannot go out and say, hey, here is business AI, and it will help you to drive productivity. Of course, we have to use it by our own to gain more productivity, but also to show our customers how we are running SAP. And when you would walk around in our labs here and everywhere in the world, 20,000 SAP developers are already using Joule for Developer. And what we are seeing is that they can produce code faster by 20%. AI-assisted contract validation. We are closing a ton of new business. So salespeople, finance people, a lot of billing, shared service people are working on this business. And with Joule for quote to cash, we actually could reduce the average contract booking time by 75%. So while we are growing our business, we can actually equip our people with AI to do their job way more productive than before. And we have numerous examples. In delivery, finance, HR, in sales, in consulting, with Joule for Consultant, which will also help us to really make SAP more simple and, of course, also more productive. People. And when you are a tech company, it's all about your people. And this year will also be the year of reskilling and learning. It was always a priority, but now so many job profiles are changing because of AI. So 15% of the working time of our employees should be freed up to dedicate to learning and development. And no matter if you are in development, in sales, consulting, everywhere, AI will change your job. And it's important to also continuously reskill our employees, more important than ever. We also hire new people. I mean, you have heard all the news about our transformation. It's also important that we added 9,000 people, data scientists, focused AI. We added also more go-to-market people in places where SAP is growing that fast, but we have not yet the footprint as some in our mature markets. That is, where we are also increasing our workforce. And then Gina and team pulled off a new cultural transformation. Best is never done. We talked about performance, which matters, and I hope it's also getting now more common in Germany that you can talk about performance. And we need performance, and we need to equip our people with the skills, but then we also need to help them to drive even better performance going forward. And that is something very important when you want to compete with a lot of technology companies around the world. And so there will be a dedicated program also around that to really equip our people with the skills, to also make sure that our leaders can drive the change, and that, of course, at the end, we also have a workforce which also can drive SAP into the future. And we are very proud about what our people have delivered in 2024. Now, when you talk about leadership, we also announced some leadership changes this morning, starting with Sebastian. Sebastian Steinhäuser started as head of strategy 4 years ago. In the meantime, he lives and breathes SAP. We gave him last year already more responsibilities on combining our operations teams, IT, processes, to not only drive strategy, but also strategy to execution. And we found, together with the supervisory board, actually, that we want to make this an executive board position. Why? Change needs to happen across SAP, and it's very important that we connect the dots end to end. And that's why we elevate Sebastian to the executive board. Also, we're going to announce Philip Herzig as our new CTO. Philip, great vision here. He's a great pioneer also in driving new innovation, even before AI. Now in AI, he did a great job, which also is a testament of the results we are reporting this morning. And now he assumes more responsibility. And in this responsibility, he will look into topics like quantum and others, and always will make sure that in 3 to 5 years, SAP is still very competitive in applying this technology in our portfolio to drive value for our customers, focusing on the long term. Now, Chief Revenue Officer, both Jan Gilg and Manos Raptopoulos will actually be the two in the box for our customer success organization. Jan will focus on Americas and our global suite. Manos will focus on EMEA, APAC, and MEE, and both will report into me because we want to continue with the successful transformation of our go-to-market function we started in 2024. Marketing will actually remain with Ada. Ada Akayet will now become our new Chief Marketing Officer. We are very happy with Ada. Ada built great bridges to sales, digitized our marketing. The marketing funnel is working extremely well, and so we are very happy with the team, and Ada will be our new Chief Marketing Officer. And that is actually it from the leadership side. Look, the past 4 years, I guess we have proven very much that we can turn an ambitious plan into reality. Now we are raising the bar. We are confident. We built a very strong foundation. And now it's about a continuous profitable growth journey for 2025 and beyond. With that, over to you, Dominik.
Thank you very much, Christian. And of course, thanks to all of you for joining us here this morning. Given it's early in the year, I would also like to wish everyone good health, peace, and success in 2025. SAP's strong finish to 2024 once again demonstrates great resilience in a year that presented new challenges and opportunities. We not only delivered on our financial commitments for the year, but also built strong momentum that positions us firmly on track to achieve our stated financial goals for 2025 and beyond. 2024 was a year of transformation, highlighted by both top and bottom line growth, as well as exceptional free cash flow strength. Our success in cloud revenue and robust non-IFRS operating profit throughout the year reflect the effectiveness of our strategic growth initiatives and our relentless focus on operational efficiency. Customers worldwide continue to choose RISE with SAP as their solution of choice for their end-to-end business transformation in large-scale enterprises, while small and medium-sized companies rely on GROW with SAP to drive their growth and innovation. This is reflected in strong order intake and large cloud transactions with a volume greater than 5 million euro, contributing 63% to our cloud order entry for the full year and an impressive 68% in Q4. Now, let me provide more details around our financial highlights. CCB, current cloud backlog, reached 18.1 billion euros, up 29%. Total cloud backlog for the year grew even at 40% to 63.3 billion euro. Cloud revenue grew 26% year on year, supported by cloud revenue growth of 27% in Q4, primarily driven by the strong performance of Cloud ERP Suite. It had an impressive year, demonstrating its role as SAP's core driver of growth, with an increase of 34% in 2024, up from 33% in the prior year. Cloud ERP Suite reached 84% of total cloud revenue in Q4, underscoring its growing contribution to our success. Software licenses revenue decreased by 21%. Finally, total revenue for the full year exceeded 34 billion euro, up 10%. This performance was mainly driven by strong growth in cloud revenue and resilience of our support business, reflecting the ongoing progress of our strategic pivot towards cloud-based solutions. Now, moving down the income statement, our non-IFRS cloud gross margin for the year continued its upward trend from last year and expanded by 1.4 percentage points to 73.3%, driving cloud gross profit up by 28%. In the fourth quarter, non-IFRS operating profit was 24% up. Operating profit growth in Q4 was mainly driven by the strong performance in SAP software licenses and support business, as well as disciplined execution of the 2024 transformation program. For the fiscal year, we delivered outstanding operating profit growth of 26% year-over-year, reaching 8.2 billion euros. The IFRS effective tax rate for the full year was 34%, and the non-IFRS tax rate was 32%, as previously guided. Free cash flow for the full year was down 19% to 4.1 billion euro, exceeding the revised outlook range of 3.5 to 4 billion euro. Recall that on top of payouts for restructuring of 2.5 billion euro, we also absorbed 0.2 billion of cash out for compliance-related settlement matters and fully discontinued SAP-triggered financing, weighing on free cash flow with another couple of €100 million. On the other hand, we received a couple €100 million from customers for receivables due in 2025, already before the turn of the year, which in combination with strong profitability enabled us to slightly exceed even the upper end of the previously guided range of 3.5 to 4 billion euro. Non-IFRS basic earnings per share in fiscal year 2024 increased by 22% to €4.53, but that then brings us to the outlook, the future. As you've likely seen in the quarterly statement published earlier today, we have provided that year's outlook by now. 4 years ago, SAP outlined bold long-term goals to guide our transition toward cloud-based solutions. Today, we are proud that this year's outlook solidly aligns with the ambitions we set in 2020, demonstrating the progress we've made in executing our strategy. Before I move on, I want to provide an update on our compensation metrics and foreign exchange hedging strategy that we will adopt going forward. As of 2025, we'll enhance our compensation framework by incorporating free cash flow as a metric alongside non-IFRS operating profit. This will ensure heightened attention towards working capital and other key drivers of free cash flow. Additionally, to reduce foreign exchange-related impacts on free cash flow, we have further developed our hedging strategy, in particular for the US dollar. As a reminder, we currently provide all income statement KPIs that are relevant for compensation purposes on a constant currency basis. Free cash flow has been and will continue to be provided on a nominal currency basis, as unlike the compensation-relevant income statement KPIs, it does include the result from foreign exchange hedges. We continue implementing a hedging strategy with a lead time of up to 1 year to mitigate the risks from US dollar-euro exchange rate fluctuations in free cash flow. By aligning hedging instruments with forecasted cash flows and maintaining a 1-to-1 hedge ratio wherever possible, we aim to reduce volatility and minimize the impact of exchange rate fluctuations on that free cash flow KPI. This approach is by now largely completed and reflected already in the free cash flow outlook we have provided today. So while the average exchange rate for 2024 and as a result the constant currency exchange rate underlying our outlook for income statement KPIs for 2025 is 108, that's the euro-US dollar exchange rate, the spot rate today at year end and even today is at 104, and that's relevant for the CCB. But the forward rate of our hedge portfolio for free cash flow for 2025 logically sits somewhere in the middle at around 106. In summary, we delivered on our key objectives for 2024, achieving strong top and bottom line results while demonstrating resilience in a dynamic environment. Customers continue to choose our solutions to help transform their businesses into more intelligent, sustainable enterprises, as reflected in our cloud performance across all regions of the world. With our foundations now firmly established, in 2025, we must remain vigilant in our execution to sustain growth and set the stage for long-term success for years to come. I also want to thank all the hardworking employees we had, and both those who remain with us and also those who have moved on. We deeply appreciate their contribution to helping SAP thrive and navigate this transformational year. And we remain optimistic about the opportunities ahead, confident that our commitment to innovation and disciplined operating strategy will continue to drive results. Thank you, and we will now be happy to take your questions.
Thank you, Dominik. Thank you, Christian. With this, we are moving into the Q&A session. As pointed out before, please say your name and the outlet. I'll take a first virtual question, and then the next one goes to Heidi. Christian, you mentioned our 40 billion investment in AI. We have a question from Bloomberg. Do you envision a European Stargate? Would you participate in such efforts? And if so, why hasn't Europe's biggest tech company done so yet?
We have done a lot. We invested, but sadly, we are investing in each country and not in one Europe. And so you heard probably about Delos. And Delos is not a marketing campaign. I mean, we had our best engineers and still working on a sovereign cloud for Germany. And there's so much talk about sovereign clouds here, sovereign clouds there. At the end, what the BSI told us, they want to have cloud, but completely decoupled from a global network. Now, when you're an engineer, know how cloud works, this is damn complex. And this is high, requirements on data security, and rightfully, actually higher requirements than what we have seen in Washington for our sovereign cloud there. Now, we do almost the same in France. Italy wants the same. Spain wants the same. So, but does this scale? No, it doesn't scale. And it's also not possible. Because at the end, you are competing, with US tech players who have, also a home market which scales. And we are benefiting, of course, also from a strong US. So with regard to the 40 billion, that is not set in stone. We want to invest. And that is actually a clear increase. But what we need is, of course, a framework where we're not asking for money. What we are asking for is a framework where it's really good for SAP to invest. And take startups with us, of course. That should be not exclusive. That is a platform which really should, one and digitize public sector and private sector. We have many regulated industries who don't want to move one-to-one to a public cloud. Fair, but do we now need to build the 28 sovereign cloud here in Germany? And then, you have, all this, in every member state, even here in Germany, you can Europe, then comes Germany. And then there is not one on the federal, then comes the states of Germany. And when everyone orders software and interprets somehow data security rules by their own, obviously nothing can fit together. It's a pretty simple logic. And that is, my ask. And that requires, honestly, also bold decisions. Will all your people like that when you take something away and centralize it? No. In SAP, the change was also sometimes required some tough decisions. But again, don't think so much about the election in 4 years. Think about what this country needs. And this country and this Europe needs more Europe, more federal, with regard to digitization. But the time to act is really now. And we are investing, but we have choice and we want to invest further. But again, not only we, everyone on the private sector needs this framework.
Thank you. Heidi Rode, Börsenzeitung.
Hi, good morning. If you look at the numbers, very impressive numbers, still the share seems to take a break or even a small dip. So what do you make out of it? Is this a reaction to yesterday's news where investors getting in doubt about the perspective of the Western tech industry regarding to AI progress? What is your view on that? And the second question, if I may, is about the management changes you've mentioned. You have a new CTO who is obviously a visionary, as I understood, but he is still not member of the top management, but part of the broader consultancy team, as I understood. So does that mean that in a company founded by Hasselplatte, the CTO is no longer so important?
Hasso. Yeah. He would be happy if he would be still in the supervisory board. He would be happy with the solution we found. And let me quickly illustrate why. I mean, first talking about the news yesterday. I mean, yeah, of course, our share developed really well. And Dominic always reminds me rightfully, what happens today, is of course important, but even more important is that we're delivering on our promises mid and long term. And what we have guided today is, in my eyes, a very ambitious outlook in a macroeconomic environment which is not easy. And when you look at the kind of growth rates, I would say you need to look really a long time, and you will not find a SaaS company with similar growth rates than SAP. Now, yesterday's news was also around, and there is a big debate also here in Germany, do we not miss a hardware company or compute, who is really playing on AI infrastructure? Yesterday actually was the day where we showed, where someone showed that AI infrastructure will scale. It will become commodity. It's of course very important because without this infrastructure, you cannot run the Gen AI modules, but more and more players entering the markets, and there will be not one large language model. So yesterday was actually a good day for SAP because it proved what we always said. We invest our R&D money into building the strongest AI foundations for businesses. And what businesses need is not only unstructured content. They need the business data. They need agents who talk to each other semantically. And that is what SAP is about. And last but not least, not every company, also not here at the German Mittelstand, has actually hundreds of data scientists sitting around and making this AI work. So also by embedding AI into our software and delivering out of the box, and that's what you can't do in on-prem, is actually 100% the right strategy. And then with regard to Philip, Philip, even before he became the head of AI of SAP, had a really impressive career. He was very fundamental in making sure that our cloud business suite is the suite we are looking at today. It's complex things. We are running complex business processes, and Philip was one of the masterminds behind, making integration work, making extensibility work, and giving us the strong foundation. Then he entered into the AI role. And now, why did we say CTO will still work very closely together with the CEO and will become part of the extended board, which is a very crucial function, which, by the way, a lot of US tech companies have as well. Philip will be now involved also in a lot of decisions around how much do we bet on quantum, how much do we bet on certain other technology innovations which are going to hit us in 3 to 5 years. He will be involved in decisions on, do we invest into a startup, into a unicorn? He will be involved into M&A. And all of these topics obviously require a close collaboration with the CEO. And that's why we said, hey, why do we want to break something which worked so well on AI? And that's how we then, came to this setup. And we will have a very powerful and empowered CTO. And even more important, we have found the right candidate in Philip.
Thank you. I will take a question from the virtual audience before we continue with Angela Meyer and then Reuters. Dominic, this one is for you, and it's about current cloud backlog. Dominic, the question is, your release says that the current cloud backlog will grow slower this year than last. Why?
I mean, first of all, there is a more technical effect, which is we have recently consolidated an acquisition called WalkMe, which added a good percentage point to current cloud backlog. And just mathematically, once you then wait for more than a year in the basis you compare to, it's also added, and then that kind of increment is falling away. The other thing is, of course, the base is growing bigger and bigger, and 29% is an extremely high number. We need a lower rate to still sustain acceleration in total revenue growth, because the cloud revenues are currently below CCB. So we have some room to sustain cloud revenue growth. And as I mentioned in my introductory remarks, the question, what is really driving cloud revenue growth, is all about the cloud ERP suite. 84% of the revenues at 30% plus growth rates for 12 quarters in a row. We think that this will sustain itself. So from that perspective, I think these are extremely strong numbers and underpin the commitments we've made to see acceleration in total revenue growth in both 26 and 2027.
And maybe one point to add. Look, also looking at our sales numbers, I mean, 2024 was a record year. I would say the best in SAP's history. Now, when you are setting targets, I mean, Dominic and I discussed also about, how aggressive do we also want to plan the numbers? And customers bought a lot of software. Still, there is enormous potential in our install base. Only 40%, so far has started the journey. The others will follow. The pipeline is really good. But of course, you also want to focus now on the customers who invested into software. It's also about building a healthy business. So we also said in the target setting, let's also focus on adoption, because we are here for the mid and the long term. It's always, easy to preload, invest, and to stimulate further sales. But I guess it's also important in the cloud that we found the right balance. And now the base is becoming bigger and bigger. Yeah, so 1 + 1 is 2 is, it's a high growth rate, but when you have a million plus a million, the growth rate becomes, a bit more challenging. That's the thing about percentage growth rates. And I would say it's also about the balance and also signal to our teams on the go-to-market side, yes, we want to win more customers and we are winning. Our win rates are way up. But what is also very important is adoption, especially around AI. When we walk into Sapphire, I want to see these customers on stage. I don't only want to feed into a hype. I want to see adoption. And that was also a little bit about the target setting. And of course, if we can prove ourselves that we can do more, of course we can do more. But I would say this was a reasonable target, an ambitious target, especially when you also look at our competition.
Thank you. Angela Meyer.
Angela Meyer, The Market, NZZ. Two questions, if you allow. First, on your, could you give us your view on your M&A strategy? So your liquidity is growing, your valuation is growing, so maybe could be time for a bigger deal. So do you have any gap in your product portfolio? So please, this is the first question. And the second, in the analyst call, you said that you have offered transformation credits in Q4 to convince all the big customers. So what exactly are these transformation credits, and did you give more of them in Q4 than in the previous quarters? Thank you.
Last question first. Every tech company, and I really underscore, every tech company works with migration credits. It's, and actually, when you look at it, it's also way more healthy than to give discounts. Because, when you can hold up your price, this is where you see recurring revenues for the long term. And so that's why every tech company also uses migration credits more as an incentive to actually convince customers to move ahead. So, and that was actually not a big change, compared to previous quarters. Obviously, Q4 is bigger from a volume perspective. I mean, that is clear. But it was now not actually a big, uptick. Now, prices actually and multiples on, customers actually pay us this much maintenance and pay us this much in the cloud actually developed very healthy. And that is also for me the most important indicator for the long term, that we have really a healthy development in our customer base when it comes to pricing. But of course, customers challenge us. I mean, they are not buying these AI use cases lightly. They want to see value. And there we also said, hey, we want to have a consumption-based and outcome-based commercial module to prove our customers that we are doing the right thing. So on the commercial side, actually, we are very happy with the progress and the trend we have seen in the last year, actually. Yeah. M&A. Look, M&A, the good piece is looking at the pipeline for this year and looking at the momentum, now we are launching in February 13 a big thing, a new offering, which will also further drive organic growth. So there is no need yet for us to acquire revenue, to do any kind of moves, just to keep up our accelerated total revenue growth. This is what we will do organically. Now, can we rule out acquisitions like we did with LeanIX, with WalkMe? If it fits really well, and it serves our customers' needs, and actually it fills a white space in the portfolio, we wouldn't rule it out, but there is no immediate need now to buy something. Think about it. Everyone also asks us why you are not acquiring, an AI company, large language modules. Yesterday was a good day maybe to show that we did well not to do it, but rather build on our organic platform. And I guess this is always, the balance what you have to strike. We don't want to just acquire for, further accelerating our growth. The pipeline is good enough, strong enough.
Thank you. Reuters.
Hakan Ersen from Reuters. Going back to the DeepSeek, did you have a chance to assess what the AI can achieve, and would you incorporate it into SAP, given that it's a Chinese company and there's always issues with data security? And a quick question: you mentioned that 2024 was a record year for SAP. Did you mean that just in regard to the sales or overall?
2024 record year. First of all, look at what we are coming from, and we should never take it granted that this company does such a turnaround in just 4 years. And I would say, no matter if you now look at order entry, revenue, health of business, I really underscore health of business. The renewal rates are way better than 4 years ago. And so customer satisfaction, these are all the indicators where I can see this was really a fantastic year. And yes, in terms of numbers and order entry and everything, it was definitely a record year. Now, with regard to DeepSeek, we of course also have in China, for China, various technology players. All the multinationals we won still do business in China. And of course, we are also using local technology in China for China. We don't use Chinese technology always outside of China, and that is also customers' choice, honestly. But we definitely want to always adhere to the several sovereign cloud standards, where we have too many in Europe. But we want to adhere to that because we want to respect our customers' data, their security requirements, etc. And so yes. But oftentimes we use the Chinese technology in China. And on the large language model side, performance-wise, this module is great. We have tested it as well. Philip and team have tested it as we test many other modules. But just to give you a European example, Mistral AI also does a fantastic job. Their module is also great. Not yet at the costs, but they are serving different use cases. So, we are testing all of these modules and we are using them in different use cases. There is not one LLM fitting all of our manufacturing use cases or finance use cases, HR use cases. So we are agnostic. And that yesterday, I guess, was really a day where it has been proven that this is the right strategy.
Thank you. Trying to get the order right. Yes.
Yes, Robin Wille, Deutsche Presseagentur. 2 questions, hope that's okay. First one, summarizing what you just said, almost everything looks pretty good. However, what potential risks do you see that could negatively impact your business this year? I don't know, looking at the global economy or political changes in the US or also in Germany. And the second question regarding your restructuring program. This should be completed at the beginning of this year, it was said. In Germany, around 3,500 employees left the company in this context, but up to 10,000 jobs worldwide are said to be affected. What is the current status here? So how many employees have now left the company in this context? And in general, looking at your restructuring programs, was that it for now?
Yeah, coming to your first question, Robin, first. I mean, the risks, I mean, obviously, I mean, when I look 4 years back, we delivered on our promise, but this promise included a Russian market, which was pretty sizable. We couldn't really foresee how COVID, will impact us, and still we delivered. And I mean, looking at the geopolitics right now, I mean, a lot of discussion around tariffs and other things. I mean, it's hard to predict, but the good piece is in this world, SAP is super resilient. I mean, we have a very high recurring revenue share. We have a very strong customer base who is loyal, who actually, use our products. And so that is actually a good foundation to have. I mean, obviously, when you look at risks, I mean, we wanted a strong German economy. I mean, when Germany is strong, it also is to the benefit of SAP. We want to, see this economy here thriving. But the same is true, for some other markets we are playing in. And of course, you cannot always predict what will happen. But we feel very safe and bold about the outlook we have given. And your second question, sorry, Robin, was about transformational restructuring. Yeah, so some people left. We added 9,000 new jobs. Yes, the last wave of the restructuring will happen now in Q1. Then this program is finished. We are finished for the year. Now, look at all of our competitors. I mean, sometimes here in Germany, we are making up that, there is restructuring. They restructure every year. Every year. And so while I'm not saying, we will restructure again this year, for this year we are then done after Q1, I mean, can you rule it out? No, but the tech sector is moving so fast. I mean, at the end of the day, you need to stay competitive, and sometimes you have to make these very tough calls. For the time being, I don't see any further restructuring on the horizon. But I also want to say, if in 1, 2, 3, 4 years, whatever SAP needs, we will make these decisions. And again, it's of course never easy to make these decisions, but we are also doing this for the 100,000 employees who are staying. They need to work for a winning company. They need to work for SAP who is in also for the mid and the long term. So while these measures are never easy, sometimes they are necessary, but for this year after Q1, we are done. Yes.
Thank you. We have 3 more questions in the room. Please stick to one question with regards to time. If we manage, I'll get you in. Capital, FT, and then FAZ, and Vivo if we manage.
Maybe also shorter answers.
I would never say this.
You can.
Okay. Good morning. Hannah Schwer from Kapital Magazin. I believe you have a small anniversary today. It's your 5th annual press conference as like the only CEO. You talked a lot today about your team and the progress you've done. Can you talk a little bit about how you look back on your personal performance and the road you've taken?
Personally, that's a hard question. I would rather prefer others to judge it. Look, anniversaries, actually it always reminds me about the birthday of my daughter. She will hear that for her lifelong, that this was the night where I had to escape from the hospital and come here for this press conference. But again, I would say, personally, you have to always, challenge yourself. I mean, I'm also not the type of person who sits here and says, hey, great year, now let's lean back. I mean, as a CEO sometimes, but also I would say as a CFO, you need to be almost paranoid a bit about, what happens in the world, what technological innovations can come. You already, as great this day is, you're already thinking ahead about, what has to come in 12, 24 months. That is my job. And of course, there is a ton of pressure, but you have to deliver. And this is what we are in for. And personally, I have to say, yes, I learned my lessons. I mean, You always personally also developing yourself. I have a lot of support from my team. Without that, it would be impossible. But no matter if it's, think about how much time you spend. Your day has 24 hours, and you need some time for yourself, for the family, for doing sports. It's very important. But then how much time do you spend internally? How much time do you spend with research, with universities, with customers, and so on? And so you personally develop. And so that was a journey also for myself. And, this journey is never ended. I mean, I tell this also to our employees. The moment we rest and be satisfied and, just celebrate each other, how great we are, and at that moment we are running a big risk. And so that is the kind of mentality what we have to have, especially in this sector who's so moving so fast. Yeah. And then these bold decisions, look, this is sometimes, and I had to learn that as well. You're doing decisions and sometimes the media won't like it, people won't like it, customers. But I even would say, when you look now at the customers, to say innovation only, AI in the cloud. I mean, trust me, it's also to the best for our customers. And of course, some customers said, yeah, but why can I not have it singular for myself? It won't work, it won't create the value. And we also need to move forward as a company and innovate where everyone is innovating in the cloud. All the tech players in the US made this shift for some time. And so you need to strike the balance, and you have to make those decisions, and these decisions are never easy. And I had to learn also honestly how to make these decisions and stay resilient and stay course, which is never easy when you have to always this quarterly pressure. But I'm not alone in this.
Thank you. FT?
Can you share a little bit, Florian Müller, FT, can you share a little bit more on why you decided to create this extended board? And can you maybe also share some information on the departure of Jürgen Müller? Are there any updates from the company side?
Yeah. The extended board, I mean, of course, we are also looking at, together with the supervisory board, first of all, looking at setups of other tech companies. And, my ask to the supervisory board, and of course, talking to Dominic and the team, Gina, was, hey, our day has 24 hours. And, this is, in the meantime, a very sizable company, and we need scale. And then when you're looking at the extended board, it's for us now a great place where Ada comes in from marketing, Dan Beck comes in from the US, talking about success factors end to end with our two go-to-market chief revenue officers, and we will discuss a lot of portfolio topics, M&A, investments in research, and it's very good to have this diverse team together and making decisions. And also it allows us as an executive board to scale, because you are reaching at a certain point your limit, and this extended board is really allowing us to scale and make faster decisions. On Jürgen, I have to say, the supervisory board, we made a decision, and now it's actually you have to reach out to Jürgen or someone else to see where we stand. I'm busy with running this company.
So with that, Herr Freitag.
Okay. Bernd Freitag, Frankfurter Allgemeine. Could you give us some insights about your talks with the Deutsche Börse concerning the weight in the DAX? Will you stay in Germany if the Börse doesn't change their rules?
Yeah, it's a little bit of a pity that we kind of outgrow the DAX. There was a cap at 10%. We were successfully negotiating that up to 15%. Now we kind of bust that gap, that cap again. I think it's simply a result of the digital economy taking a larger and larger share of the economy at large. If you look at the top 10 market caps on the planet, in 1980 there was only one, which was IBM in technology. In 2000 there were 4. It was Microsoft, still around today in that bucket, Intel, Cisco, and one European company called Nokia. And today there's actually 8 if you include Tesla, because it's also a technology company. So you see how the digital economy is really taking a larger share. And we don't find it very intuitive that you then cap that digital technology only because in one country it's concentrated on one company, in this case SAP. But the good news is our strong efforts to attract US investors are bearing fruit. We spend more time there, and there is a huge demand in the US in terms of capital to be allocated. If you think about the 3,000 billions being invested in the biggest tech companies, if you only kind of are able to attract a tiny share of that, that more than offsets that point of view. But in total, I think it's more about the general regulatory environment. How conducive is the regulation in Europe for a company like SAP? We just mentioned one topic like that cap in the DAX. And there are many other things that hopefully the wake-up call we receive from the United States will resonate and then give us some opportunities to thrive even better in the future.
Thank you, Dominik. Last question, Vivo. Short question, short answer.
Hi, Michael Kroker, Wirtschaftswoche. One question. You are really bullish on your approach towards AI. Can you give, or will you give some certain numbers how this AI use cases influence your revenue?
I mean, Michael, we talked today about, the 50% of, AI use cases embedded in the deals. What is, I guess, fair to say, when you buy a supply chain or HR software from SAP, there is a certain bookings impact already in the CCB. And of course, it will go very fast because we embed it, also be turned into revenue. And so when you look at the overall CCB growth and how well this is developing and the kind of acceleration, what you can see, of course, the strongest lever is AI. So we don't break out, revenue numbers, but I guess, 34,000 customers using AI, and I underscore using, is actually a pretty strong testament that there is a lot of value. And when you look at now the next wave of AI, and we have prepared there an early glimpse around agentic AI and SAP, cash collection example, you see, how we are sitting really at this nexus between business and technology. And so we are very confident. And the outlook we have given, the acceleration on total revenue is, a lot of that is, of course, also related to AI.
Yeah, thank you very much. We are running out of time. Thank you very much for everyone joining us online. In case of any more questions, please feel free to reach out to the global PR team or myself. Thank you very much for joining us. Have a great day. And for everyone here in the room, and we go off link now.